Have you ever wondered how a huge company, or even just your local coffee shop, takes all those thousands of daily sales, bills, and payments and somehow boils it all down to a simple report that says, hey, we made a profit? Well, the magic behind that is something called the accounting cycle. And in the next few minutes, we're going to break down all 8 steps of that process, taking you from a single transaction all the way to the final financial story. You know, it really all comes down to this one question. This is pretty much the reason accounting even exists. It's not just about crunching numbers, it's the language a business uses to talk to itself, to figure out if it's actually winning or losing. So, here's our game plan. First, we'll tap into the financial heartbeat of a business. Then, we'll get into the nitty-gritty of recording every single detail. After that, we'll see how we adjust things for reality to make sure our numbers are spot on. Then comes the big show, presenting the results. And finally, we'll wipe the slate clean to get ready for the next round. So what is the accounting cycle really? Honestly, think of it like a machine. On one end, you feed in all the financial chaos of a business, every sale, every bill, every single payment. And on the other end, out pops a set of clean, simple reports that tell you exactly what went down. It's the system that brings order to that chaos, and it just repeats, period after period. And here it is, our roadmap for this whole thing. Now, these 8 steps might look like a lot, but they follow a really logical path. We're going to start by capturing just one transaction and follow it all the way through the system until we have our final reports. So let's dive in with step 1. All right, our first section is all about what I like to call the financial heartbeat. This is where it all begins. It's about spotting those individual economic events, the transactions that are literally the lifeblood of the business. See, nothing gets recorded until it's first been identified. Okay, to make this whole process feel real, we're going to track one super simple, everyday transaction from start to finish, a $1,000 rent payment. By following this one payment, you're going to see exactly how these first few steps of the cycle actually work. So, step 1. This all happens in your head, really. Before you write down a single thing, you have to stop and analyze what just happened. We paid $1,000 for rent. Okay, what does that mean? It means 2 things changed. The amount we've spent on rent this month went up, and, well, the amount of cash in our bank account went down. And that's key. Every transaction will always affect at least 2 things. Step 2 is where we finally put pen to paper, so to speak. This is called journalizing, and it's basically like keeping a financial diary for the business. This diary has a name. It's called the General Journal, and every single transaction gets recorded in there one after the other in chronological order. And this is what that diary entry looks like. Now, here's where we meet the 2 most famous, or maybe infamous, words in accounting: debit and credit. But don't let these words scare you off. For now, just think of them as left column and right column. For this whole system to work, the left side, the debits, must always equal the right side, the credits. A simple rule of thumb: expenses go up on the left with a debit, so rent expense gets a debit. Cash is an asset, and it's going down, so it gets recorded on the right, with a credit. This perfect balance is the bedrock of the entire system. Now, the journal is great for telling the story day by day, but what if you just want to know, hey, how much cash do we have right now? That's where step 3 comes in, posting to the ledger. Think of it like this. The journal is your diary, right? The ledger is like a set of organized folders. We take every entry from the diary and file it into the correct folder. One for cash, one for rent, and so on. So now, anytime we want, we can just peek into the cash folder and see its current balance. Okay, let's hit pause for a second and see if you're getting the hang of this. Here's a classic situation. You did the work, so you've earned the money, but the customer hasn't paid you yet. How would you record that? Here's how you do it. The money that someone owes you is an asset, and it's called accounts receivable. Since your assets went up, you debit accounts receivable. At the same time, you earned revenue, and revenue increases with a credit. So you credit service revenue. And this highlights a really fundamental rule. You record revenue when you earn it, not just when the cash finally shows up in your bank account. Okay, so we've been busy recording all our daily transactions, but our financial story isn't quite complete yet. Now we move into what I call the adjusting for reality phase. This part is all about editing and refining our numbers at the end of the period to make sure they're perfectly accurate. Before we do anything else, we have to run a super critical check. Step 4 is creating the unadjusted trial balance. All we do is list out every single account in its balance. The only goal here is to answer one simple question: do our total debits equal our total credits? This is our first big safety check to catch any simple mistakes. And this slide shows you exactly why that check is so important. If your trial balance looks like this, with the totals not matching, everything stops. Red alert. You've made an error somewhere. Maybe a number was typed wrong or an entry was lopsided. You absolutely cannot move forward until these two columns are perfectly equal. Now for step 5, adjusting entries. These are for all the financial events that happen kind of gradually behind the scenes. For instance, maybe you paid for your insurance for a whole year up front. Well, at the end of the month, you need to record 1 month's worth of that as an expense. Or maybe your delivery van got 1 month older and lost a little bit of its value. These are real financial changes that have to be recorded to make our reports accurate. And these are some of the usual suspects you'll see. Accrued expenses, for example, are costs you've racked up but haven't paid for yet, like employee wages for the last week of the month. And depreciation, that's just the fancy term for how we account for the gradual wear and tear on our big, expensive stuff, like computers and vehicles. So once all those behind-the-scenes adjustments are made, guess what? We run the numbers again. This is the adjusted trial balance. It's our final check to make sure debits still equal credits, but this time the balances themselves are way more accurate. You can think of this as the final, approved draft of our financial data for the month. With our numbers checked, double-checked, and polished, it is finally time for the main event, creating the financial statements. This is where we get to publish the story that we've been writing all period long. Step 7 is the big payoff, preparing the financial statements. And listen, the order you see here is non-negotiable. It has to be done this way. First, you prepare the income statement. Why? Because you need to calculate your net income, your profit. That profit number is then a required ingredient for the next report, the statement of owner's equity. And then the final number from that statement is needed to make the balance sheet actually balance. It's a chain reaction. Each statement feeds the next one. The story for this period has officially been told, but business doesn't stop, right? So our final section is all about closing the books on this chapter and getting ready to start the next one totally fresh. And that brings us to the very last step, closing the books. You can literally think of this as hitting a reset button. We need to zero out all the temporary accounts, and that means revenues, expenses, and any money the owner took out. These accounts only measure performance for this period, so by resetting them, we make sure that on day 1 of the next month, we are starting from a clean slate. Now, accounts like cash or equipment, those are permanent. Their balances just carry over. And this is what it's all about, a big, beautiful zero. The temporary accounts are all back to nothing, ready for next month's business. The profit we calculated has been neatly transferred into the owner's equity account, which permanently captures the value we created. The cycle is complete. We are ready to start all over again with the very next transaction. And that's it, the 8-step accounting cycle. It's a disciplined, logical process that takes hundreds, maybe thousands of individual transactions and turns them into a clear, understandable story of how a business performed. So it really just raises the final question. Now that you know the process, what story is your own financial data trying to tell you?